Hello and welcome to the fourth episode of Multifamily Investing with Bob Biggins. I'm obviously Bob Biggins, and this will be our third and final module of the underwriting, which is how to get a deal going. Determining, is it a good deal or is it not a good deal? We're going to review the income and expenses today and give a few examples on the key documents, which is a balance sheet, an income statement, which is oftentimes called a P&L, and a T12, which is a trailing 12 months of revenue, expenses, and which comes out to be the net operating income. So you can see by column and by row what expenses are the highest or lowest, what the revenue sources are, what months are better, etc. So that T12 is very important. It's usually part of the broker package that you'll receive from a commercial broker and sometimes a residential broker, depending on the size of the deal. Income and expenses. These are different things that you can expect to see in your T12. And we'll start with income, because a lot of times people just think of rent as your income, but really you could have anywhere from 8 to even 15% more revenue from other sources of income. So obviously rent is number one. You can have prepaid rent, which it's just money on the books that is there, but it'll eventually it'll pay down that month's rent. You have pet rent. Sometimes could be $20, $30, $50 per month. Every month is pet rent. Washer dryer, coin-op washer and dryers are a good source of income. Parking. A lot of times there's covered parking or garage parking or parking right next to your apartment rather. And those are sometimes upcharges. Even some A-class properties will have valet parking, even at that, for apartment complexes. We've got one right here people may not know of. That's RUBS. That's Ratio Utility Budget Billing Systems. Ratio Utility Billing Systems. What that means is having some methodology of sending the expenses back to a tenant or a resident. If one fourplex, for example, 4 2-bedroom, 1 bath has 1 boiler, and every month you get 100% of the gas bill, and you have a small amount of common area, it may be a 23%, 23%, and then the landlord pays 8% potentially for any common area hallways or anything like that. So that would be part of a RUBS system. They actually make RUBS programs that will do all the calculating for you and send that information back off to the tenants every month. Another one is water bills. There's also could even be electric bills if there's one source of electric for 2 or 3 units, depending how they're set up. It could be for water and sewer if there's a well and septic. There's always costs there with pumping and electric for the well and any salt or culligan or anything like that. That's like a hidden charge that oftentimes landlords will absorb when a billing system back. They can receive those charges back as other revenue. Credit checks. Under the system that we use, Tenant Cloud, our residents, future residents, they pay for their own credit checks. But in some businesses, credit checks are a source of income. Some landlords, some businesses, some property management companies will charge a fee on top of the fee to run people's credit. We don't do that, but some sources, for some organizations, that is a source of revenue. Cleaning fees. That could be a big one when people move out. Our leases, we build in a standard carpet cleaning fee because they're going to be either new or professionally cleaned when someone moves in, and so we'd want to make new or professionally clean when someone else moves back in. So that is a fee built in that we utilize on our leases. Not really a cleaning fee. Pet fees are common when you're moving in. Some people do pet fees, and some people do pet rents. Some people do both. When you got to keep deposits, unfortunately, you keep the deposits, but you have to pay that money right back out again to do any repairs or maintenance that needs to be done based off of the person moving out and leaving things over normal wear and tear, which is the legal standard, at least here in Michigan, is normal wear and tear. Anything over normal wear and tear is the resident's responsibility. Anything normal wear and tear is the landlord responsibility. And then late fees, or if people don't take advantage of a discount, depending on how leases are structured. If you pay by the first or the second of the month, but if you don't, you got to pay the standard rent, which is X, as opposed to the discounted smaller rate, which is Y. Now the other end of the equation is expenses. And there are a lot of expenses that can be had in multifamily. This is just a tiny, tiny fraction. When I've got a P&L or a T12 up from a large broker, large deal, 50, 60, 80 units, there could be 70 or 80 line items of expenses. This is just a small sampling that you may see on a more residential small deal, maybe on the MLS. So you got the basics. It's going to be utilities. If you pay them, they will be an expense. Water, gas, whatever. Property taxes, usually very high. A key thing with property taxes are, once you buy a property in Michigan for sure, and I believe in Indiana as well, the property taxes get reassessed. And they're going to be based on the SEV, state equalized value, and they're going to be generally much, much higher, especially if the owner has owned it for a long time. So that's one thing when you're buying a property, really check out, or have your real estate agent check out what your taxes are projected to be, because it could blow a deal. If you have $5,000 or $10,000 or $20,000 more in property taxes you were not counting on, it could wipe out every bit of profit you were counting on in that deal for the first several years. Next is insurance. Insurances in the state of Michigan have gone crazy. In multifamily, there's many deals that just that can't even be underwritten because insurers are pulling out. Big juggernauts like Berkshire Hathaway and Farmers, they've pulled right out of the state of Michigan for smaller deals, potentially only, such as single family, and really that's about it. I think they only do single family now. They won't do any new commercial, but they will do existing commercial. They will enlist policies oftentimes, because I have several Berkshire Hathaways and I can't get any more, but I can keep the ones I have. God forbid I have a claim, and I probably won't have them for long after that. Next are the grounds. That would be mowing, salting in the winter, plowing, all those type of things. Obviously, tree work in the spring and fall, just any large-scale project, or really anything that has to do with the outdoors, pressure washing concrete, all those type of things. Property management. That's one, if you're in small residential, you may do it yourself. So you have no property management fees, but you should always bake in property management charges for when you go to sell the deal, because many people won't be wanting to do their own property management. Big deals, they automatically write in property management charges. Banks and larger lending institutions, they automatically write in anywhere from 5 to 10% property management. So you got to bake those into your numbers when you go to buy or to sell, because the lender will put those into the equation. So that's a expense that is really just property management company gets the revenue for. Just being under their umbrella, using their softwares, using all their tools to manage the property. Not to be confused with employees and benefits. In a big deal, maybe 60 to 70, 80 deals, 100 unit properties, you'll have generally one leasing agent and one maintenance person. And those people work for the property management company. Now, all their salaries, all their benefits, you pay all of that. So there are two different line items on your expense column. Is property management, which is just for the company being hired, software, know-how, training, etc. And then the actual employees that are trained to do the work for you. So those are two different line items. And again, in smaller deals, that's not the case. But if you're looking at larger deals and you get a hold of brokers and they can send you larger deals to evaluate, that's what you'll see. Maintenance, oh Lord, maintenance, you could have 30 or 40 or 50 rows for maintenance. Not uncommon to have drywall maintenance, plumbing maintenance, electrical maintenance, flooring maintenance, painting maintenance, or just painting. So there's several facets of maintenance or property improvements. Services, those things like exterminators, pressure washing, the side of your building, window washing, things like that are all services. Clerical. The clerical is sometimes different than the property management. The stamps, the envelopes, the softwares they may use, the computer, that may all be a clerical expense. Notepads, whiteboards, computer chairs, those all could be a clerical expenses. And then last but surely not least is legal. And that's when you have an eviction or you need advice or any type of legal endeavor such as that. So there are revenue and expenses. Revenue has a smaller amount of rows, but expenses are of many, many rows, many. And these are just a very small snippet. Now, I'd like to review just a very brief set of documents that are used primarily in larger multifamily. If you reach a commercial broker, they're probably going to send you a balance sheet, a T12, and then an income statement, year-end income statement. So I'm going to go review these briefly. These were amazing because I didn't want to use anyone else's that were sent to me because you have to usually sign a non-disclosure agreement. So I couldn't tell the people on my podcast or my YouTube channel that this asset has so much in revenue expense, and I didn't want anybody to see their type of documentation on there. So I think I looked on Google I couldn't find anything I really liked, and I thought, well, heck, I'll AI it. And so Grok, which is XAI, Elon Musk's AI version, I have that downloaded, and I created this entire little portfolio in Grok. And I would recommend, if you're not doing AI, to learn it and use it. It's very simple. It enhances your productivity. You can't even believe how much it'll enhance your productivity. And I know people say that, and I'll probably do a video on that and do some examples, because even just small things. I was able to create a balance sheet, a T12, an income statement for, we call it Kalamazoo multifamily property. I told Grok to do anything in Southwest Michigan, and they created all this for me. This is a typical deal, a typical 20-unit deal. So we'll go through balance sheet, and that's really just you determining what your liabilities and really your owner's equity. How much equity do you have in your property? So to list out your assets, such as cash, receivables, deposits, are just a very high level amount of current assets, and a non-current would be less depreciation, and then capital improvements, and that would give your total assets of, say, in this example, a $2 million purchase, it'd be $2,053,000 in assets, and then liabilities, which would be what is owed to you, security deposits, they were up top $18,000 as an asset, but you got to show it down here as a liability, because it's not yours. You're just holding on to it. It's in a fund, in a trust rather. And so total liabilities, would be down here at 1.418 million, and you subtract those out, and you got 600,000 in owner's capital, and then 634,000 in owner's equity. And they bought it for 2 million, so they've generated or created 34,000 more in value for the property, at least on the balance sheet. The next document we're going to look at is the T12, and this is what's used the most in multifamily because it gives you a good snapshot of how each month has been and how you can budget for each month going forward and what expenses. Now this T12 is very, very small. I mean, very small, but it gives the general idea. Generally, the months are along the top and the line items are on the column side, the row side rather. But in this example that Grok created, they had the months in the rows, in the row column, and the gross rental income, less vacancy, and then other income, and that's the effective gross rent, and it pulls out the expenses, and so it shows your net operating income to be 13.2, 12.9, 13.6, right on down the line, for a net operating income for the year of 166 on rental income of 258. That's a good deal. If you got an asset like this, you've got a good asset. And it's in good shape. Throwing off this kind of money, that's a good asset. And so you can see down below the breakdown is how much the expenses are for property management, utilities, repair and maintenance, and so on. And then at the end of the year, they take all the T12 numbers and they create the year-end profit and loss statement. And that's generally what you turn into your accountant, your CPA, and your bookkeeper, or your bookkeeper will generate it for you, depending on if you do your books or you hire people to do your books. And they will come out with this document that just really consolidates the T12 into income, expenses, and it shows your net operating income for the year, which in this example was 166,000 that we saw from the T12 minus the debt service, because the net operating income does not take into account the debt service and your mortgage. And so your net income for the year is 82,532. Pretty darn good deal on a $2 million investment. So there we have it. That is underwriting session number 3 coming to a close. Podcast number 4. Please like and subscribe. And I will see you for a podcast number 5, which I will be interviewing the largest the largest broker, ERA broker in all of Michigan, Rick Reardon from Jackson, Michigan, and I will be interviewing him shortly, and that will be podcast number 5. Thank you, and have a good day.